Okay, in this lecture, we're going to study Chapter 3, Working with Financial Statements. We're going to carry on our study of financial statement from last chapter. So after studying this chapter, we should be able to understand financial ratios. So specifically, we want to be able to compute and interpret some common financial ratios. And also, the goal of it is to understand the determinants of firm's profitability. So the goal of a firm is to maximize shareholder value, and shareholder value is coming from two types of decisions: investment decisions and financing decisions. So that affects shareholder value. And there are two aspects of investment decisions: efficiency of assets and profitability of sales. And also there are two aspects of financing decisions: leverage and liquidity. So as you can see in this chart, shareholder value depends on good investment and financing decisions, and financial ratios can help measure the success and soundness of these decisions and also allow for comparison through time and between companies. So we're going to measure shareholder value as return on equity, or commonly called ROE for short. So it measures firm's profitability. So we want to understand the sources of shareholder value. So we're going to decompose. We're going to learn how to decompose firm's ROE. So ROE is defined as net income over total equity. Okay, so that's ROE. And let's multiply both sides by total asset over total asset, which is 1. So this preserves this equality. So it's a legal operation, legal mathematical operation here. So that is 1. Okay. Now I'm going to rearrange this a little bit. So this over this. So net income over total asset times total asset over total equity, total asset over total equity. So I've decomposed ROE into two parts. The first part, the first financial ratio, this ratio is called return on asset, or ROA. The second ratio is called equity multiplier. So equity multiplier measures the effects of accumulated financing decisions. So whereas ROA largely measures the effects of firms' investment decisions. We have ROE on top. So equity multiplier, which measures total equity to total assets to total equity. So if total debt increases, then equity multiplier increases as well. So it measures financial leverage. So leverage is, so there's a heavy object. So you want to lift this thing here. So you can use a leverage. If you use a leverage like this, then you can exert a small force to lift a heavy object. So you can use leverage and convert this small force into large force. So that is called a leverage. So use of that is leverage. Financial leverage allows firms to use small amount of equity to have large amount of total assets. So it measures financial leverage. It's called equity multiplier. So it kind of multiplies this asset. So when total debt increases, obviously equity multiplier increases, as we've seen before. How about its effect on return on assets? So total debt increases, then interest expense also increases. So net income is net of interest expense. So increase in total debt will decrease net income and also decrease return on asset. So use of debt will increase equity multiplier and decrease ROA. But effect is usually, the first effect is usually larger. So increase in financial leverage tends to increase ROA because its effect on equity multiplier is much larger, typically, but not always, but typically, than the effect of its effect on ROA. So net effect is typically positive. So we're going to decompose the success of investment decisions into two parts to better understand the firm's operations. So we're going to start from here. So again, ROE is net income over total asset times equity multiplier. So I'm gonna multiply by sales over sales, okay, which is 1. So this preserves equality here. So then I'm gonna rearrange this a little bit. So net income over sales. So net income over sales times sales over total asset times equity multiplier. So the first ratio is called profit margin. And the second ratio is called total asset turnover, which measures the efficiency of use of assets, and profit margin measures profitability of sales. Okay. To summarize, ROE is equal to ROA times equity multiplier, which is equal to profit margin times total asset turnover times equity multiplier. So profit margin measures firm's profitability of sales. Total asset turnover measures firm's efficiency of assets. And equity multiplier measures the firm's financial leverage. And this decomposition is known as the DuPont identity, named after DuPont, the chemical company, who popularized its use of financial analysis for their internal evaluation of their divisions, which turns out to be very powerful. And we're going to apply this DuPont analysis to a real-world companies here. So GameStop versus Best Buy, head-to-head. So I've chosen these two companies because I believe that these are fairly well-known retail companies that I hope that you guys are all familiar with. And sometime in 2017, I purchased a PS4 console along with Call of Duty Infinity Warfare. So I stopped by GameStop and I stopped by Best Buy to make the purchase. And it turns out that it was a pretty interesting time for GameStop and also for other retail companies because of the rise of Amazon. So let's look at the GameStop's operation in early 2017. So for the following analysis, please have these two questions in mind. So we want to be able to answer, so which firm is better, GameStop versus Best Buy. So head-to-head, GameStop versus Best Buy. And also, we want to be able to answer which will be a better investment. And as we will see, better firm not always a better investment. Okay, so here we have the financial ratios for GameStop. So here, income statement and the balance sheet. I have already calculated some numbers for you, except for the ROE for GameStop for 2017. So we're going to compare GameStop with Best Buy, and I also have Amazon for comparison. So the financial ratio is very powerful because it allows us to compare the firm's performance over time to see whether things are improving or deteriorating, or we can compare across firms like this. So this can give us a better context to understand numbers. So GameStop's ROE for 2016 So ROE is defined as net income over total equity. And net income numbers here. And we want the numbers for 2016. Okay. So it's here. So net income is 353.2. So if the numbers are too small to see on your screen, please see our lecture notes. So I have my lecture notes on my laptop here. So net income is $353.2 million, and total equity can be found on the balance sheet. Here. And we want the number for 2016, which is this. Okay, so this is let me see, 20 to 54.10, 2254.10. Okay, so we use the number on January 28, 2017. So typically, calendar year goes from January to December, but from fiscal year, may not coincide with the calendar year. So for GameStop, fiscal year starts from February. So fiscal year 2016 starts from February 16 and goes to January 17. So the end of fiscal year 2016 is actually the number that we have on January 28, 2017. So ROE is, I believe this is 15.7%. So let's put it in here. So let's see, let's look at the numbers. So as you can see here, let's look at GameStop time trend of ROE for GameStop. So the GameStop ROE is decreasing. It's decreased quite a bit from above 19% to have fallen below 16%. So that doesn't seem very good. Which sort of makes it worse is that if you look at Best Buy's ROE, seems to have improved in 2016, right? From 20.5% to 26.1%. Also, if you look at Amazon, right, things have improved quite a bit, almost increasing 6 to 7% each year. So things are improving greatly, very rapidly for Amazon, and also a little bit for Best Buy as well. But for GameStop, it's a different story. So things are not going well for GameStop. So we're going to dive deeper into to see what's happening with GameStop. So we're going to decompose ROE into two parts, ROA and equity multiplier. So again, ROE is ROA times equity multiplier. Let's first compute equity multiplier for 2016. Okay. So we need to look at the balance sheet here. So we have to the equity multiplier is defined as total asset over total equity. So total asset can be found here, and total equity, we already have used it before, is here. So we have to use the number on February 28th, 2017, which is the end of fiscal year 2016. So total asset is 4975.9 over total equity is 2254.1. So equity multiplier is 2.21. Okay. So that number here is 2.21. As you can see here, for GameStop, didn't leverage gone up a little, but not much, not a lot. I've gone up by less than 10%, so 0.13 percentage point. So very small increase of equity multiplier. And also what you can see is that compared to Best Buy and Amazon, GameStop is relatively moderately leveraged. Best Buy and Amazon had greater financial leverage, which may explain some of the difference between GameStop's ROE and Best Buy's ROE. So leverage tends to increase ROE. Okay. And because this has gone up a little, so if ROA stayed at the same level, then it must be the case that ROE should have gone up a little. But ROE has actually come down quite a bit. That must mean that ROA must have decreased quite a bit. Let's see if that's true. So ROA okay. So ROA is defined as the income over total asset. The net income number is here, 353.2. Total asset number is here, 4975.9. So return on asset is, I believe this is 7.1%. Okay. Return on asset, ROA, is 7.1%. Okay. As you can see here, ROA have decreased quite a bit. So again, compare this to Best Buy and Amazon. So again, the Amazon things have increased quite a bit. And for Best Buy, although Best Buy had a little bit bad year in 2015, but after that things have improved quite a bit. So its ROA for 2016 is still greater than 2014's number and is a large improvement over 2015's number. So things are not so great for GameStop. Okay, that seems to be a big issue. So we're going to decompose this further to better understand what is wrong with the GameStop's operations. So we're going to decompose ROA further. So again, so ROE is ROA times equity multiplier, and ROA is profit margin times total asset turnover. So that is ROA. So we're going to decompose ROA into profit margin and total asset turnover. So profit margin is net income over sales. So net income here, 353.2. Sales is the top line here. 86.8607.9. So profit margin is, I believe this is 4.1%. Okay. Net income divided by sales or revenue. So profit margin, this number is 4.1%. Okay. So if you compare this number to previous year's numbers, so 4.2, 4.3, 4.1, yeah, this has decreased a little bit, but stayed above 4%. Okay. So profitability doesn't seem to be an issue for GameStop at that point. And actually, GameStop was highly profitable if you compare the profit margin for GameStop to Best Buy's and Amazon's profit margin. So Best Buy profit margin was 3.1, 2.3, and 3.1. And Amazon profit margin was negative. So in 2014, so it was losing money, but things have turned around and have improved quite a bit. So profitability was not an issue for GameStop at that, in 2016. And that must mean that total asset turnover must have been an issue. Let's see if that's really true. So total asset turnover total asset turnover, sales over total asset. Sales is here, 8607.9 over total asset was here, 4975.9. I believe this is 1.73. So total asset turnover ratio is 1.73. Okay, as you can see here, GameStop's total asset turnover have decreased quite a bit from 2.1 to 2.2 to 1.7. That's a big drop. And we've compared this to Best Buy and Amazon. Things have improved quite a bit. For Best Buy, so turnover was 2.6, 2.9, and then 2.4. So it looks like Best Buy in 2015 sacrificed profit margin to increase turnover. Okay, and in 2016, that strategy seems to be paying off. Okay, and for Amazon, total asset turnover stayed more or less at the same level. So that seems to be a problem that GameStop seems to be having at the time, which agrees with my impression. So I stopped by GameStop store sometime in 2017. So I stopped by GameStop store. Okay, it had huge store space, but not many customers. So total asset turnover is sales over total asset. Lots of store space, but not a whole lot of customers means small sales. So that seems to be the problem that GameStop was having, which you can see, which shows up in the financial statement. And then I stopped by Best Buy. Also, it has a lot of the store space, but there are a lot of customers, and I ended up buying my PS4 and Call of Duty from Best Buy. So going back to our questions, so head-to-head GameStop versus Best Buy. So which is a better firm? Well, the answer seems to be pretty clear. Best Buy is a clear winner. So no offense to GameStop, but Best Buy seems to be a clear winner. And how about which is a better investment? This is not clear, at least from the analysis so far. So the reason is that we have to distinguish good firms and good investments. So good firms are highly profitable. So good firms tend to have high ROE. But investors can recognize this. So let's look at the past performance, the stock performance over the past 5 years. So let's focus on the past 12 months here, where during this time things are improving for Best Buy, or things are deteriorating for GameStop. And investors recognize this, and push up the stock price for Best Buy and depress prices of GameStop shares. Okay. So Best Buy have become more expensive, whereas GameStop has become cheaper. So we have to also consider valuations. So we can, the common measure of valuation is what is called market to book ratio or price to book ratio. Price to book, which is so the market price per share and book value of equity per share. So market to book ratio or price to book ratio. So if you look at GameStop, so this is GameStop's price to book ratio is close to 1, whereas Best Buy's price to book ratio is over 3. So Best Buy seems to be about 3 times more expensive than GameStop. How about Amazon? Amazon is on the right scale. So Amazon is about the book to price to book ratio is over 20. Okay, so Amazon is way more expensive than both GameStop and Best Buy. So investors recognize this future potential for Amazon. So as you can see here, good firms tend to be expensive. So in two-dimensional graph here, so if you had ROE on the x-axis, so quality and junk, so high ROE is good companies. And if you put price to book on the x-axis, so expensive, so high market to book or price to book ratio means expensive. Low book to market ratio means cheap. Okay, so good firms tend to be more expensive, right? So even if quality firm, if it's too expensive, then it could be bad investment. So bad investment. And low quality firm, if it's cheap enough, then it could be good investment as well. So we want to find companies that are alive on this side, not on this side. So we have to combine value and quality. We have to consider both dimensions to determine whether certain firm is a good investment. Okay. This is a very popular investment strategy on Wall Street. So here's a book called The Little Book That Beats the Market. Actually, this is a second edition. In the second edition, the author Joel Greenblatt added the word steer. So Joel Greenblatt is a hedge fund manager of Gotham Capital. So he advocates this strategy, combining value and quality. So he proposed what he named magic formula, combining value and quality. So he proposed measuring quality by return on invested capital and propose measuring value by ratio of EBIT to enterprise value. So here, price is in the denominator. So high ratio means cheap, okay, and expensive. And high return on invested capital means quality. And low means, you know what it is. So its relationship is typically like this. So Joe Greenblatt proposed to investing in companies that lie over here. So it's called measure formula, which kind of sounds like some kind of scheme, but it's actually based on good investment principles, which is buy good companies, but only at bargain prices. So if you're a non-finance major and interested in investing in the stock market, and if you don't have a lot of time to study, then this is the one book that I would recommend. It's a little book, so you take a day or two to read it and still learn a lot about the investment. Also, combining value and quality is also practiced by Warren Buffett. Okay, here are quotes from Berkshire Hathaway's annual report. So as you can see here, so whether we're talking about stocks or stocks, I like buying quality merchandise when it's marked down. So Warren Buffett also recommends investing in quality companies, but they are not too expensive. And unlike Joe Greenblatt, who seems to put equal weight on value and quality, Warren Buffett seems to be putting a little bit more weight on quality dimension, as you can see from this quote. So it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And so we're going to learn in later in chapter 8, we're going to learn equity valuation. To determine whether firm is a good investment or bad investment. So to answer this question, we're going to have to wait until we study chapter 8. But for now, this should conclude today's lecture. Thank you for watching, and I will see you next class.